Welcome to the Pulse Podcast, where we discuss the latest trends in workplace technology and healthcare equipment, from artificial intelligence to business transformation. I'm John Plantier, Director of Channel and Enablement Business at DLL. On this episode of the Pulse Podcast, we have someone I have a tremendous amount of respect for, Senior Market Strategist of Global Economics and Markets for Rabobank, Christian Lawrence. And today we're going to dive into some hot topics from a macroeconomic view. And we've called in the big guns to do so. Christian, thank you for joining us today.
Thanks for having me, John. Really pleased to be here.
Absolutely. So let's get to it. One of our favorite topics, Christian, I think at this point, it's a word that you wish you could eliminate from your vocabulary, but let's talk about tariffs and tariff policy. From a tariff policy perspective, what are you watching most closely and how might they affect global supply chains?
Yeah, great question. And of course, tariffs have been all we've really been talking about in 2025 so far. And look, I think the short answer to your question is China, Europe, Canada, and Mexico, because those are the US's biggest trading partners. But I think really to answer your question properly, we need to think what this administration is trying to achieve. Why are we seeing tariffs suddenly emerge after decades of a relatively low tariff environment? And it is worth just coming with the backdrop here that tariffs are nothing new. Go back a couple of hundred years ago, and we saw very heavy tariffs on goods coming into the US. But of course, in the post China entering the WTO world in the 1990s, it has been a relatively low tariff environment. If you think about the effective tariff rate on goods coming into the US, very low single digits overall. That has now moved into double digit territory. We're at about 12.5% effective tariff rate at the moment. And I think the question is, where do we settle exactly? And to cut to the chase here, our estimate is we'll probably be somewhere just above the 15.5% lower bound of our expectations. 24.5% was the upper bound. So probably somewhere around the sort of 17, 18% mark. But going back to the meat of the conversation, why are we seeing tariffs from this administration? Well, I think it's really a driver behind what the current administration is engaging in, i.e. a grand macro strategy, using statecraft, using the US's structural strength to try and force other countries to engage in foreign policy that the US thinks will either make it more prosperous or more secure. So yes, we've heard about Trump talking about wanting to reduce trade imbalances. That is certainly part of it. We've heard Trump talking about wanting to increase revenue. That is, again, certainly part of it. Tariffs are a de facto tax. We can argue about who exactly pays that, but certainly some of it is borne on the consumer for sure. But the other story I really think is reindustrialization. Now, make no mistake, this isn't about bringing back millions of people onto the factory lines to sew clothing. That's not what's going to happen here. But I think what this administration has said is, look, we know that China has emerged as this global manufacturing force, and that has been at the cost of manufacturing in the US. But of course, there has been a reason for that, primarily cheap labor. But I think now, as we look to the future and you see the rise in robotics, the rise in AI, and around about more than half of all manufacturing robots sold in 2024 was sold into China. And essentially, if we're looking at a world where more and more manufacturing is actually going to be automated, you need less and less people. Well, then China doesn't have quite the same advantage that it once was. So I think the administration is saying, well, if we fast forward 10, 15 years down the line, maybe you don't need many workers in factories. So why not try and divert the capital allocation away from China back into the US? So that we see more in the way of infrastructure being built, so that perhaps 10 years down the line, when you don't need many workers, the US is able to manufacture competitively. And the other story there is, of course, security. Since COVID, a lot more goods are now deemed security risks than were thought of before. So things like microchips, pharmaceuticals. We saw the difficulty during COVID of getting hold of some of those because of supply chain disruptions. So the desire is essentially to shorten supply chains so much they happen domestically. So I think that there's a few things that are really driving this move, but certainly there's a lot of tools you can use. And at the moment, the administration is focused on the tariffs.
Gotcha. Yeah, there's a lot to unpack there. And I heard you say a few times there. We think, we think, we think. So, which leads me to say that it might be a little ambiguous as to what the administration is doing. It's not very clear. Would that be a fair statement?
Well, I think I think with the way things are being carried out, some question marks arise. So, for example, if we take the tariffs on steel and copper and aluminium, those make sense if you're trying to bring back production to the US, because of course all of those are security issues. We need to be able to produce steel, copper, aluminium domestically for military reasons, and of course, as we're seeing the rise in technology for those reasons as well, and not being reliant on other countries. So from that perspective, that might make sense, but at the same time, it's not like the US can suddenly produce a new steel mill in a couple of
Mm.
months. So in the meantime, those very high tariffs, in some cases 50%, can be very damaging to the economy. So when we say we think, there are some measures being put in place that might not fit with achieving those goals that I stated earlier. And again, perhaps this just comes down to implementation. There's been a lot of sticks and not many carrots so far. Maybe the carrots are coming. We know that policy is very volatile indeed. We've heard tariffs being announced in the morning and then being retracted in the afternoon. And I know that only too well because they get announced in the morning. I sit there trying to work out what it means. And then 4 hours later, I realize that I've just wasted 4 hours. So that hits home, that's for sure, John.
So full disclosure for our listeners, we're having this conversation on August 12th. So anything we say here might be old news, right?
Definitely. It might be old news by the end of today, John.
Oh, that's great. So speaking about old news, new news, let's talk about some of your indicators. And when you take a step back and look at this market, what indicators are you looking at, Christian, to give the overall health from a macroeconomic standpoint?
Well, the simple answer there is inflation and labor. The Federal Reserve has a dual mandate. Most central banks just focus on inflation. The Fed actually focuses on labor and inflation, so it has a meaningful impact in what they do with interest rates, which of course has a huge impact on the economy overall. So, from a very, very high level, inflation, labor remain the main topics. That being said, what's been very interesting, and you mentioned it's August 12th today, we actually had CPI inflation data out this morning, roughly in line with expectations. We saw the core coming in at around about 3%, so not the 2% target that the Fed has. And we are starting to see some upward pressures emerge, but it's fair to say that inflationary pressures are certainly not where they were just a few years back. But the big question mark is, when do tariffs start appearing in the data? And there have been some early signs of that, but we probably need to wait a few months before we'll see truly what sort of impact it's had. But the other topic that I do have to mention, given what's transpired recently, is the quality of data. So when you think about data releases, some of them
Mm.
are actually estimated by the statistical agencies that produce them. Some components aren't actually real data, they're actually created by models. And what we saw in CPI inflation today data today is that there was a higher percentage of that number being driven by a model rather than actual data. And of course, if it's driven by a model, then that means it is liable to issues, particularly in an environment that's very difficult to model. And I can tell you that as someone whose job it is to try and model the current. Of course, this was very much front and center of the news recently when we saw the labor data coming out, which is released on the first Friday of every month. The non-farm payrolls, it's often called, you get the unemployment rate alongside it. And what happened with the non-farm payrolls, which is the number of jobs that have been created, is there was a downward revision of over 250,000 to the prior 2 months. Essentially, what that tells you is that the data when we got it was completely useless, and just a couple of months later, we found that out. The issue here is that this is a survey-based report and response rates have collapsed. So there's a big question mark over the actual quality of the data that we're seeing. And it's hard enough to predict what's happening at the moment if you know exactly the data's perfect. If the data themselves are questionable, then it poses an entirely new risk. And of course, we actually saw Trump fire the head of the BLS in reaction to this. What I
Right.
will say is that it's quite right to have concerns over the quality of data at the moment. There's another very good example of that. Historically, we often use consumer confidence surveys as a good lead for actual consumption. And that makes sense, right? If I ask you how are you feeling at the moment, you say I'm feeling great about the economy, I'm feeling great about my job, you're probably going to be spending more. If you're worried about getting fired next week, you're probably pulling back on spending. So historically, that's been a good lead indicator for future consumption patterns. The issue is post-COVID, it hasn't worked very well. And what we're seeing in the consumer confidence data this year is when you break things down by political allegiance, it's a very different picture.
Mm.
Republicans generally feeling pretty confident, Democrats not feeling very confident. So the quality of that data as a lead for the real consumption data has diminished as well. So essentially, economists, we're working with kind of blunt tools at the moment, which is problematic.
Yeah, so it sounds like depending on how you feel, you could feel really good about the current situation, or the other end of the spectrum, you could feel very bad.
And it just
Hey,
depends who you usually vote for.
yeah.
And I think the other thing that I should mention here is, the US is a consumer-driven economy, the highest percentage of GDP driven by consumption of any country in the world. And it's worth bearing that in mind. A third of global household consumption happens in the US. That's more than China and Europe combined. That's why the US is threatening tariffs from a pretty strong standpoint. But
Mm.
what I would say with the consumer is when you look at the aggregate numbers, it points to a consumer that is starting to slow, but hasn't collapsed yet. But if you dig below the numbers, you'll find that the top 20% of households in the US have never been in a better financial position. The bottom 20% of households are worse off than they were before COVID hit. So it's a very, very divergent picture when you look below the surface. And certainly when we speak to our clients, that's very evident. If your customer base tends to be high income groups, things are going well. If it tends to be lower income groups, then you're seeing sales decline already.
Gotcha. So you mentioned something when we were talking about inflation. I just want to pull on that thread a little bit more. And okay, so we got the inflation numbers. Core ticked up slightly. It was at 3%, if I heard you correctly, versus a target of 2%. And let's put on your Fed chair hat. You're Jerome Powell now, right? And so you got to contend with inflation ticking up here, but you got some ambiguity, lack of clarity as to what the potential impact tariffs would be. The expectation from probability markets is that we would have two rate cuts, again, as of this date by the end of the year. How does that work with the inflation ticking up now?
Now, I do have a bit of sympathy with Powell at the moment. We could argue that, rates are probably above where the neutral rate is at the moment. Neutral, we think, is somewhere between 3.5%. So you could argue that there's some room for cuts. But as you quite rightly alluded to, when you're in an environment where inflation might start ticking meaningfully higher on the back of tariffs, do you want to start cutting rates when inflation's heading higher? When your mandate is actually a 2% inflation rate and you never got there post COVID, got down to around about 2.5%, but not down to that 2% level. At the same time, the labour market is showing some signs of loosening, but the unemployment rate's just over 4%, which historically is very low. In the
Right.
same time, we have equity markets, we have crypto markets all printing new record highs. Credit markets, credit spreads have never been so tight. So this isn't an environment that really screams we need a lot of rate cuts now. But I think the very difficult position the Fed's in is normally they try and adjust policy for what they think is going to happen in the future, not how things look right now.
Mm.
Unfortunately, because of the level of uncertainty in the future, I think the Fed has kind of said, we are willing to risk being a little bit behind the curve and waiting for real signs that we are seeing a slowdown, that we are seeing the labor market loosen before we start cutting rates aggressively. And I do have some sympathy with that. Now, what I will say is that as we move into next year, the makeup of the Fed matters a lot. So within the Fed, you essentially have 7 voting members, and we are going to see 4 of those members very much in Trump's sphere of influence by the middle of next year. So we already have 2 in Bowman and Waller, and it's fair to say that both Bowman and Waller have changed their tune a bit recently. In fact,
Mm.
it was Bowman that a year ago dissented. She said, I don't want to cut rates when the Fed cut rates. And actually, at the last meeting, she dissented, saying we should cut rates when the Fed isn't cutting rates.
Hmm.
Bowman and Waller clearly leaning a little bit more towards rate cuts to try and appease Trump. We had Kugler, who was supposed to step down in January, just stepped down recently, and Trump announced the replacement there in the form of Mirren, who tends to be very dovish as well. And Chair Powell's term will be up at the end of May. Now, we've heard Trump threaten about firing him. I don't think that that's going to happen. I think Powell will stay in the position until the tenor is up at the end of May. But then when he does step down, it's another appointee for Trump. And essentially, you'll have 4 of the 7 really under Trump's sphere of influence. And I think that means we will see some cuts coming. Now, for those of you listening, this does not mean we're going back down to 0% rates that we had during COVID, that we had in the aftermath of the global financial crisis. The market is currently pricing just over 1%. So 125 basis points of cut. So 5 rate cuts by the end of next year. I actually think that's about right. So we're really talking about interest rates settling somewhere between 3 and 3.5%. That's kind of the range of expectations now. But unfortunately, for those that would like cheaper financing costs, we're not going back down to zero anytime soon.
So if you had to give an analogy based on where we are and this economic environment, do you have a good analogy for our listeners?
If any of you have ever been in a snowstorm or a dust storm where you can't see your hand in front of your face, that's probably the best analogy. Now
That's a good
that's a
one.
little unfair. That's a little unfair. But look, we are going through a huge paradigm shift in the way the world works. We've moved away from hyper-globalization. We are moving to a much more fragmented world, a much more kind of neo-mercantilist world, if you will. And whenever you go through these huge structural changes in the way the world operates, it is always very, very difficult to predict the future. You know, I've been doing this job for 19 years, and I like to think I've got a pretty good track record of forecasting, but certainly the most difficult periods have been just after the global financial crisis, during COVID, and quite frankly, right now.
Yep. No, and that's good. And one word, if you had to describe it, give me a word. And remember, this is the clean podcast here, man.
Difficult. um, no, look, if I had to think of one word, wow, I would say transition. We are going through
Transition.
just a huge transition in the way the domestic economy works and the way the global economy operates. And look, some of this was happening before COVID came along. COVID certainly accelerated things. You know, we really learned that yes, supply chains were cheap and efficient, but they were also vulnerable. And I think that coinciding with an end of sort of the real free trade, the hyper globalization period. That's a tricky time, and it's a time of transition and it's a time of change.
Yeah, transition, change, and lack of clarity as you sit right now. And I think that's what the
Exactly.
value that DLL has as being a vendor financing shop is when you provide financing, it gives you that clarity.
Yeah.
It's much easier to see when you get into a financing contract to say, okay, you're locked in. So that gives you that clarity, which is why we're so vital to the economy and gives that peace of mind that I think people are searching for right now.
Exactly.
Um,
It's a way to navigate all of the volatility out there that isn't going anywhere. We are going to remain in a very volatile environment. Interest rates will be moving, currencies will be moving, and we see a lot of divergence between different types of industry. So I think any way of getting some stability through that is certainly a huge positive.
Exactly, exactly. So a topic that is hot on everyone's mind, and you mentioned it a few times here, is artificial intelligence. And you mentioned, hey, part of the tariff game is getting investment back into the states is one piece of it. And that's not necessarily the manufacturing jobs, but that could be a revolutionary. Talk about AI when it's highly skilled approaches, robotics. In your view, what does this AI revolution look like to you in the future?
Yeah, and of course, that's another reason why microchips are such a hot commodity at the moment. Essentially, you know, microchips have become like oil and like water.
Mm,
Countries need them; they're coming into everything. And as you quite rightly alluded to, there's been a lot of focus on things like these large language models, but actually AI is very relevant for the physical world as well. We see that the advancements that you get on the software side move into advancements on the hardware side as well. Now, what I will say in order for anyone listening is that whatever's happening with AI, it shouldn't do away with interest rate, currency strategists, and economists. Their jobs need to be very, very secure. Just let me get that on record.
And just
But
full disclosure, commercial leads, sales managers, there's still a spot for them, right?
exactly, yeah.
Okay, cool. Okay, good,
So,
good.
so
Yeah.
now we've just made the case that our jobs should be safe. No, seriously. Joking aside, look, I think there's a few aspects here. One is huge capex investment in the US that is not going away anytime soon. The more these technological advances happen, the more we will need in terms of investment, because whether it's factories needing to either a complete rebuild or refurb to get with the modern technologies, that's going to be absolutely critical. Those factories built in the 50s and 60s probably have a much shorter lifeline left now than we thought they did 10 years ago. The advancements are happening at a breakneck speed. Now, what I will say is that this isn't going anywhere anytime soon. So
Hmm.
I think for our clients, when we're thinking about their capex plans, yes, we know we're in a period of volatility at the moment, and that can be scary. But make no mistake, these technologies aren't going anywhere, and you don't want to get left behind with them. If we're talking from a very, very sort of big picture perspective, I've been in the US for 11 years now, actually hoping to become a citizen later this year. And I'd say over those 11 years, I've become a much more optimistic and positive person. But I'm originally from the UK, and we're a gloomy bunch over there. So if I think about what my US outlook is on AI, it is that we could see huge productivity gains as a result of this. We could all become a lot more efficient, and we could end up in some kind of a utopia. If I channel my inner gloomy Brit, then I would question whether it would lead to mass unemployment, huge social unrest, and rather than a utopia future, more of a dystopia future. Two completely opposite ends of the scale. But I think there's some things we can say for sure. Will AI destroy certain jobs? Without a shadow of a doubt. But historically, when we had the Luddites complaining about the end of the printing press, and we've seen all these other periods before, whether it is the invention of the internet and other technological advances, there was always the concern that it's going to destroy jobs, and it always does destroy jobs. Like that old joke that the horse never recovered from the invention of the car. But what we do see is that historically, every time a new technology comes along and everyone panics, it actually ends up creating more jobs than it destroys. There are different types of jobs, and that will certainly be the case with AI. As I said, if I channel my inner gloomy Brit, perhaps AI is different. The most dangerous words in economics are always "this time is different." But there haven't been many technologies that come along that touch upon so many different types of work, whether you're a singer or a model or you're a lawyer or you're an analyst. The bottom line is AI is relevant to your role. So I think it's too early to tell exactly, and there are two potentially very, very different paths emerging, one very good, one very bad. Let's just hope it's the good, and the American side of me wins out from that positivity perspective.
Ah, well, hopefully everything works out with you becoming a citizen. That would be excellent. Congrats on that front. Christian, great conversation here. Any parting thoughts that you want to leave us with?
Yeah, I suppose, one thing I didn't mention on the AI front that, of course, is very relevant for DLL, you lease equipment, and new equipment is going to be how other companies perform well and how you beat your peers by having the most up-to-date stuff. So I think that that's a huge opportunity going forward, and, reach out to your DLL reps about that, because I think it is important to keep up to speed with things because technology is moving very rapidly indeed. And the other thing I would say is don't panic. Yes, there's a lot of noise at the moment. There's a lot of volatility, but there's always opportunity when there's volatility. We always panic about volatility as being a bad thing, but it does create opportunity, and it's just a question of finding those opportunities that work for your businesses.
Well said. If this economics thing doesn't work out for you and you want to venture to the sales side, just give me a ring.
Will do,
Well,
John.
Christian, thank you so much for your insights. Great conversation here. Again, I'm John Plantier, director of our channel Enablement Business. We sat with Christian Lawrence from Rabobank, our parent company today. Great conversation, and stay tuned for another exciting episode of the Pulse podcast. Thanks, Christian.
Thanks so much, John.
This podcast is brought to you by DLL Group. All rights reserved. This podcast is for general information purposes only and should not be used as a substitute for professional advice. The opinions expressed in this podcast are solely those of the participants. Nothing herein should be construed as legal, tax, financial, accounting, or investment advice. Please visit www.dllgroup.com/aboutus for further details.